All right, so we're going to jump right into it. Everything you absolutely need to know about credit scores, from the most basic stuff to some hacks, we're going to drop on you right now, right off the top, because we know you need to know. And those of us who think you know, guess what? Sometimes when it comes to credit, there's a lot that you may have missed because you never got a financial literacy course in high school and college.
Right.
At any point in your life, most likely.
And why does it matter? Because someday you're going to want to buy a car. You may want to lease a car. You may want to buy a home. You may want to rent a place. They might run your credit. So all this is very important.
Yeah, so a bit of a caveat right off the top with this. Fannie Mae, okay, a government-sponsored enterprise, GSE, well, they are now actually kind of pivoting away from the traditional credit scoring process to other algorithms. As of today, the date of this show, which happens to be March 5th, 2024, this is still the credit score that everybody uses, the FICO scoring system. But in the not-too-distant future, this will consider to be outdated because this is not a true and accurate representation of your risk as an individual for credit purposes, and why the way we use credit has changed so dramatically in the last 10 to 20 years.
And you'll see really soon why it'll be easy to actually manipulate your score.
So right off the top, factors that make up your credit score: payment history is 35%. The single largest chunk of your credit score is made up by how consistent and on time you make your payments over the course of your lifetime.
Right, it's true. So just take it one step back. So a credit score is any score that ranges somewhere between 300 to 850. Chris, what's yours?
820 something.
820 something. Mine's 805. And this actually, in order to have anything above 700, this needs to remain perfect. You cannot have any late payments. And we don't mean a late payment by several days. That happens, but really what we're talking about is like a 30-day late payment that gets marked and it gets sent to the credit bureaus.
Yeah, a lot of people freak out like, oh my God, I didn't pay my payment. I'm 5-10 days late. You're generally okay. Unless you're literally 30 days late, generally speaking, you're not going to get reported to a credit bureau. And if you are in that time, you can dispute it with the credit bureau. So right there, good point of fact, there are three main credit bureaus, okay? Equifax, Experian, and TransUnion. Believe it or not everybody reports into all three, and not everybody pulls all three reports. All three reports, when somebody goes to all three bureaus and pulls it back, it's something called a tri-merge report. They're pulling basically all three credit scores. There's going to be a high one, a low one, and a middle one. And most people who are going to say, hey, Saeed's FICO score is 805, they're going to take that middle score, and that's really what the 805 is reflective of.
Right, exactly. And something else, that one little rule of thumb that I kind of live by, if I ever opened up a credit card, one thing that I automatically did off the top was set up automatic payments. So that way, for sure, it's always hitting the minimum payment. That way I never, ever have to worry about a late payment towards like my credit card.
Yeah, fantastic way to do it. I actually do a sweep like this for one charge that comes through on one smaller credit card of mine that doesn't go on the Amex, and that because that charge gets extra coverage through my bank for like my cell phone and stuff like that.
Right.
But yeah, that kind of leads us into the next, I guess, kind of segue, if you will, collection accounts. If you happen to be in a situation where your account was not paid on time, you happen to go into something known as collections. Basically, the original person who had the debt has sold it off to somebody else to collect, or they have their own internal collection department, and they show you on your credit report as past due in collections.
Right.
Okay. If you do not pay the full amount paid as owed, and you pay lesser than, it actually impacts your credit score. So if you call up your previous vendor, let's say it's American Express, and you say, hey, I owed you a bunch of money. Now I'm in collections. I know it was $5,000. Would you take $2,500? They say yes. Even though you paid and you paid less than agreed, it actually dings your credit score pretty significantly still, even though you paid it current, or paid it off, I should say, because your account's going to be closed at that point in time.
Right. And let's just say you do, for whatever reason, you apply for credit somewhere and you do get access to your credit report, and something like this does pop up. This is something you need to tackle and get ahead of like right away. Right. A big problem back in the day. It's not as much of a problem anymore because lenders are now looking at it differently, like Chris mentioned at the top of the show. But a lot of times what a lot of people would get hit with these medical collection accounts.
Man, those used to hit credit reports all the time. There's been some new law changes too,
Yes.
which kind of significantly limited the ability for them to get on your. People would have literally collection accounts on their for like $10 copays that they didn't get billed when they went there. They sent them a bill afterward. They never got it. And these $10 copays would wind up in collections for
Right.
medical collection agencies. And you'd be like, come on, man.
I had seen that happen so many times and and then I would even be leaving the hospital and say, "We'll bill you the pay." I'm like, no, I'm gonna pay it right now.
Yeah, I'm gonna go ahead and do that now.
Yeah, exactly.
I don't trust you, bro.
Yeah, exactly.
All right, so if you have a credit card, and let's say you've got a $5,000 limit, okay, amounts owed is 30% of your score. So again, payment history 35%, amounts owed 30%. And utilization ratio is a key part of amounts owed. So for example, if you have that $5,000 credit limit and you're using all $5,000, you're fully maxed out, but you're paying on time and everything else is paid as agreed, that's actually going to lower your score. It has a 30% impact to your overall score, and that can be bad for you. Now, on the other hand, if you're on the extreme opposite side of the spectrum and you have zero utilization, but $5,000 of available credit and you haven't used a single dollar of it, guess what? It actually isn't that good of a thing for you either.
Right.
There's a healthy medium, and it's really, really hard to navigate because there is no hard and fast rule, but you need to use a little bit of credit and pay it down and pay it off.
Right.
But you don't want to use too much credit and utilize way too much where it looks like you're maxed out.
Exactly. So a little rule of thumb that I've always lived by, I don't know if there's any true science or any good information out there to back this, but I use a 30% rule. Never go over 30%. Make sure it never crosses that barrier. And typically, in the past, I'm not going to act like I've never carried a balance over month over month. But when I am managing my debts properly, I'm paying them off, to their fullest. But never crossing that 30% threshold. Like Chris said, if you have a $5,000 limit and you're using all $5,000. Why does that seem so bad? You're like, wait, they're giving me access to $5,000. I should be able to use it. Well, the credit bureaus and other lenders who are looking at this might see you as being in financial distress, and they may not think you're able to pay back that $5,000.
All right, so I'm going to give everybody a free hack here. One of the questions I get asked a lot about is, hey, Chris, how do I get a Centurion card? I want the black card, right?
Ooh.
So, and I think people misunderstand that this is something that it's not. But what I will say is you really get a card like that by having a disciplined ideology around your utilization ratio and paying consistently over time. The 65% of what makes up your credit score that we already spoke about, it really is the key to getting there. Now, obviously, you have to spend a lot in order to get it, and you have to have certain assets and net worth and all these things to look at. But it really comes down to those. And the reason why it's so important is, number one, I use an American Express card because it's a charge card, not a credit card. And there is a main difference. A credit card, you can pay the minimum payment at the end of the month, right?
Right.
And while American Express does offer charge cards where you pay the minimum payment at the end of the month, but you still have a balance after you make that payment, the traditional American Express methodology was a charge card, meaning you pay the entire balance off at the end of the month. Mm-hmm. And for those of you listening to the show for any prolonged period of time, you know that we recommend you have a credit card, which you put all of your spending on that you can. It builds you loyalty points. It keeps all of your charges onto one card, and criminals, fraud that comes through can't get to your bank account. It gives you that separation of church and state, if you will, and it allows you to dispute charges. And American Express is spectacular when it comes to disputed charges. So it was really that consistency of use of that charge card, which I paid off every single month, that as my spending built up over time, really built, number one, a loyalty with them as a brand. Number two, I showed a pattern and practice of paying it off every single month in full, and I never spent more than I actually planned on paying off at the end of the month. And number three, it showed that my spending was progressive load over time.
Right.
Right. And because it's all on one card, it shows the maximum spending because I'm spending all of my spending there. Mm-hmm. So, and that is a good kind of way to run into the next section. Loyalty does matter to credit cards. Believe it or not, length of credit history is 15% of your score. So again, payment history, 35%, amounts owed, 30%, and now length of your credit history, 15%. If you're 18 years old, you get your first credit card, guess what? Your length of credit history is not long.
Right. So something that you want to always keep in mind is, I remember when I was in college, I opened up a college credit card. It was at Wells Fargo because at the time I was working for Wells Fargo. I no longer have my accounts there, right? But that's now my longest
trade line.
Trade line, exactly.
Actually, bro,
there
industry jargon.
You saw where I was, you know where I was going? Yeah. So it's my longest trade line. So even though I don't have bank accounts with them anymore, it would actually hurt my credit score if I close down that card.
That is correct.
Because it impacts my credit history and it's there for so long.
Incrementally
right?
So I've got a couple different tips here that I think are uncommon, okay? Number one, when I was 18, actually, no, I was younger than that, I think. My dad walked me into Wells Fargo. He opened up 3 accounts for me: a checking, a savings, and a credit card account.
Perfect.
I still have that credit card account to this day.
Mm-hmm.
Now, the reason why I have it to this day is because it doesn't hurt me because there's not an annual fee associated with it.
Right.
And because it works as overdraft protection, I think, for my original other accounts in a worst case event scenario that I needed. Mm-hmm. That being said, I don't ever use it. It doesn't hurt me. No point in closing it. But my limit on it is like $15,000 or $16,000. Meanwhile, I've got a Centurion card with literally no limit on it.
Right.
And this is a good point for everybody else. If you're trying to get a credit card with a higher limit, the odds are you're going to have to open up a new account somewhere else as you financially grow. Because you can increase your income over time. But keep in mind, if you're using your card appropriately, you're only using about 30% of it at most, right? Or maybe you max it out once or twice ever. You pay it down, and let's say you're doing all the right things. Most credit card providers aren't going to give you a massive increase without you calling and asking for it. Even if you call and ask for it, it's not going to be that significant. You're better off applying for a better card with a higher limit as your career progresses and as you start to make more money over time. Because unfortunately, whether you like it or not, your current vendor is unlikely to meet your needs as you grow and scale.
Right. And typically that'll happen with the institution that you're currently banking with, because they're also seeing all the activity that's coming in and out of your account, right? Mm-hmm. So they're able to cross-check and verify everything, because they do actually come out and ask you what your stated income is.
Right.
But they're able to see whether if that makes sense or not based on the activity levels in your account. Now, something that I found out later down the line was that credit card that I originally opened up with offered something like a cell phone insurance plan. Have you ever heard of this?
Yeah, that's why I use my current Wells Fargo card still to this day. Is it runs through there and it automatically auto pays from my auto drafts from my checking account.
Yeah, and so I've actually had to use this before when my cell phone screen cracked, and all I had to do is pay a $50 deductible, and they covered the entire cost. Mm-hmm. So I'm like, oh, why would I ever get rid of this? Not to mention my length of credit history.
Although I will admit, Centurion just told me they had the exact same service, but a better one.
Yeah.
So now I'm thinking about closing the Wells Fargo one. But
right.
So again, this is also worthwhile to think about. If you have a credit card that has an annual fee, right, it may be worthwhile to close it. And a great example for those of you who want to know about the American Express side of things, and this applies to all credit cards, not just American Express, when you get the offer to join the Centurion, status, whatever the bullshit is, right? You get the Plaid card offer. They keep your old Platinum card.
Okay.
So you don't actually upgrade the card to another one. That's it. You have your old card. Well, that old card, I think, has like a $700 annual fee for it. Plus, the American Express has their membership initiation fee. Plus, it's $5,000 per card annually for that Black card.
Wow.
So it makes no sense, especially if you know how I spend on one card, to have the Platinum card and the Black card.
Exactly.
So what do? We said, okay, this has got a fee. Yes, it hurts my credit score incrementally to close the account, but we're not going to use it, my wife and I. So we literally close those because we don't pay the annual fee.
There you go.
So we decided to take the small nominal hit to our credit score and close down the length of time that credit's been available, knowing that we're going to rebuild a little bit of that with this. And it only took about a year or so to kind of bounce back up.
Right. And that's something worth noting, right? If you are going to make a move like this, you kind of have to foresee like what you plan on doing in the upcoming future. And if you know you don't have any big purchases in mind, or if it's something that can be easily explained to a lender, right? Mm-hmm. Then sometimes lenders will accept a letter of explanation to kind of explain what happened there.
Yeah. So, and then the next item on this is obviously new credit. 10%. 10% of your credit score is made up by opening new accounts in a short period of time. Now, that sounds like unreasonable for most people, but when you think about it in the context of life, there are several different types of credit out there, right? You've got long-term installment loans, like auto loans,
right?
Like home loans.
I mean, they have some now as high as 10-year auto loans now.
Yeah, wild.
Crazy.
But you can have a 40-year mortgage, man. We've called it before.
Yep.
That's happening.
Mm-hmm.
Moment of silence for all of our finances. Anyway, then you have like student loan debt, and you'll have term, like revolving debt, like credit cards.
Yes.
Now, all three of those are actually different types of credit that report on your credit report.
Mm-hmm.
But all three of them are very, very different indicators of your ability to repay over time. Obviously, your mortgage carries a much longer history, so having a mortgage can actually anchor your credit score in a good, healthy standing. But for so many of us, we can't get that. So what am I going to tell you? Really focus on making consistent payments on your auto debt, because that term debt over time, that installment loan, being paid down from a very large amount to a very little amount over the course of years, is going to wind up being an anchor to your credit score when you're starting out.
And once that actually does get paid off, it doesn't hurt your credit score the way if you were to close down a credit card. This actually will boost it up once it's actually paid off because the type of credit that it is.
Correct. And then lastly, types of credit in use makes up the last remaining 10%, which we've kind of just covered a little bit. But what I will point out is that you need to think about how you're going to attack these things over time. A lot of people go, oh, great, I learned it. I want my credit score to be amazing. It doesn't stop there once you get that score. You have to constantly be monitoring this. A lot of banks, a lot of credit card companies will offer you something called a Vantage score or a soft pull kind of look, and they'll basically give you their recreated number for you. Basically, they're not pulling from Equifax, Experian, or TransUnion. They know what the algorithm is for the credit score, and they know essentially where your numbers are coming from in a soft pull. And they're recreating what your score most likely is based on your current activity, which is why Saied and I know what our scores are. We're not pulling our credit reports all the time, but we know that that's effectively what our bank or our credit card tells us our effective equivalent score is as of today.
Right, exactly. And why this should matter to you is if you have a good credit score, right? Let's say somewhere above 750, around to where Chris is at. What'd you say you're at?
820 something.
820 something, right? You're going to get better interest rates from lenders because they believe you're less risk than someone that doesn't, right?
Mm-hmm.
So if you're going out to buy a home that's $400,000 right now, median sales price of a home, right? And you put down 20%, $80,000. You're getting a loan for $320,000. You might get a 7% rate. Someone with a lesser score might get an 8% rate. You might say that's only a 1% difference, but that's a difference of $220 a month in your payment.
Yeah.
Right? So now think, we'd all like to have an extra $220 in our pockets. Now imagine if you could have taken that $220 and just invested it, right? Over the long haul, how much money could that make you?
A
lot of money, right? So this stuff actually matters, and you want to set yourself up for financial success.